Thanks for joining us. Good afternoon. My name is Corey Donovan. I'm a co-founder of ImpactPHL and now run point on community engagement for the organization. I'll keep my part brief here because we have a great program that Sandhya, one of our speakers, wrote an article about a year and a half ago, maybe longer, and I've been wanting to do this program since, so I'm pretty excited for our discussion today. But just a couple of quick housekeeping items. I want to say thanks to our funders. Without them, we literally couldn't do our work. So you see their logos. There's some others with names that aren't listed here. But again, we literally wouldn't exist without support from our funders. Also want to make sure that you're aware of two upcoming programs that we have. The first one next month, February 26th, put that on your radar screen. We'll be talking about Beyond Returns, talking to your financial advisor about what matters most. A lot of people who don't know how to talk to their financial advisor or don't know what to do when they push back or don't know or are stuck with terminology or how to navigate that conversation. And what we know is a lot of financial advisors are sitting back waiting for people to ask and tell them that's what they want. So we want to encourage that. We'll be recording this discussion today as we do with all of our sessions, and we'll post that link to the event page on our website. We have a calendar with all of our past events. So any session that we've done, that we've recorded, our archive, our library is there. And so with regard to this conversation today, if you had some board members that you think need to hear this, you'll have a video you can share with them. We'll take questions via the chat today. So if you have questions or comments, please use the chat for that, and we'll be monitoring that actively. And I think with that, I'll turn things over to Beth. Beth has done a very good job of curating today's conversation, so I want to applaud her for that. And I'll let you take it away, Beth.
Thanks, Corey. I'm so glad you and ImpactPHL has convened all of us today, and all of you are joining us to explore what would fiduciary duty to the community look like. As Corey mentioned, it was inspired by an article Sandhya wrote maybe a year and a half ago that really struck a nerve among those of us who have an interest in moving capital and investing money in alignment with their values. I think we'll have a really robust discussion today. But before we dive into it, I'll just ask Sandhya and Kate to introduce yourselves and your interest in the topic.
Yeah, thanks, Beth. Appreciate you having me here. Appreciate ImpactPHL having me here today. And appreciate you spotlighting this article. I'm Sandhya. I use she, her pronouns. I'm one of the co-CEOs, not co-founder, co-CEO of Common Future. I co-founded an organization called Community Credit Lab, which is focused on impact-first investing and really focused on demonstrating a lot of what I have talked about in the article of how we can really reorient investments to community. So that's my interest, and that's why I'm here. And over to you, Kate.
Thanks, Sandhya. Hi, everyone. I am Kate Baronelli-Conte. I am the co-founder of Capital J Collective, which is the hat I'm wearing today in this conversation. I have many years' experience as an advisor as well, but at Capital J, we're really working on doing strategic consulting to organizations and individuals. We're trying to grapple with the bigger questions up and outside of that work in terms of their values, and the choices they have inside our current capitalist system in ways to align their values with how they make those choices. So that's why I'm here and happy to join this conversation today.
Great, thank you. And I'm Beth Diffley. I'm a corporate lawyer. Haven't founded anything actually, with a focus on capital raising and corporate governance, and I regularly advise on fiduciary duties. So I have great interest in this topic, and as we explore it, I thought I could start us off by spending just a little time level setting on what fiduciary duty is and when it comes into play. And of course, I'll give a disclaimer that none of this is actually legal advice. I'm just a lawyer and someone interested in the topic. I try not to take up too much time on this, but I think sometimes people throw around the words and say what you can and cannot do, and we should really sort of understand what they are. And so I'll just start by saying fiduciary duties are imposed on those who manage assets, whether it's financial assets or an actual business enterprise that are owned by someone else or held in trust or a similar form for someone else's benefit. And so the party who has the management control has obligations to the organization, the owner, the beneficiary. And right at its core, there are only two fiduciary duties, care and loyalty. Sometimes there are some others, but they're really all derived from one of those. Sort of straightforward. Duty of care demands that that fiduciary act with the care a reasonable and ordinarily prudent person would believe appropriate under similar circumstances. And so what does that mean, right? Act thoughtfully, deliberatively, and in an informed manner with a reasonable process. And interestingly, when we're talking about prudent management of institutional funds, that does require, when exercising decision-making around accumulating and spending funds, the fiduciary should consider both the duration of the fund and the purposes of the institution and the fund, both of those things. And then there's also the duty of loyalty, which requires that the fiduciary act in good faith in what they believe to be in the best interest of the organization or the owners or the beneficiary, not in their personal interest. And the beneficiary's interests take precedence over any other constituency. Conflict should be avoided. And when the context of trusts and pension funds, that duty of loyalty has also led to this idea of a development of a duty of impartiality to act impartially to all beneficiaries, current and future. So, that's sort of very general and really doesn't provide an easy yes or no checklist. That's why lawyers can be gainfully employed. The approach to, making judgments is complex. And so it provides for actually just a fair amount of flexibility. And especially in the corporate context where there's a lot of case law to guide decision-making, where there's no self-interest or duty of loyalty concerns, decisions are generally going to be upheld if they're made on an informed basis, in good faith, in the belief that it's in the best interest of the beneficiary. So there's no hard and fast, non-negotiable answer that a fiduciary must maximize financial returns or preservation of capital. On the other hand, there's also not a clear green light for different action. So the main takeaway is really that there's going to be careful, informed, deliberate decision-making focused on what's in the best interests of the beneficiary. So if I were giving legal advice, I would also say maintaining a good record of having done that work and how any decision was made is important here. So sort of with that background of what sort of it is and how that's very nuanced and leaves a lot of room for thoughtful decision-making, I think what's more interesting is to sort of dive into this question of what fiduciary duties can and should be. And as Corey said, we'll try to save time for questions and monitor them along the way. So please put them in the chat. But to sort of dive into Sandhya, your article, which was the impetus for today's discussion. You've talked about when people were trying to raise capital when you were trying to raise capital for community investments, investors would raise fiduciary duty as a roadblock. And maybe sort of recognizing that trying to fit within the existing framework, while possible, is maybe insufficient to achieve the change wanted. You've raised this idea of reimagining the concept. So maybe just sort of tell us about that and provide that background.
Yeah, thanks, Beth. Before I answer this directly, I wanted to actually start with a quote from an Indigenous scholar, Leanne Simpson, whose quote I revisited this last week. And I really think it grounds us in actually what we're talking about today. And really actually not only what we're talking about, but also like how I'm approaching this work. And she wrote in her book, As We've Always Done, if we want to create a different future, we need to live a different present so that present can fully marinate, influence, and create different futurities. So really the orientation that I have coming into this conversation is in recognition of the fact that what we've been doing in the past, and specifically for today's conversation, how we've interpreted fiduciary duties for mission-driven institutions and capital sources is not really creating the future or the futurities that we want. And as we're sitting in the midst of polycrises, this really gives us an opportunity to examine how we can shift differently in the present to really reorient towards the future that we want collectively. And maybe to click a little bit deeper, when I say what we've done in the past, I'm really talking about our orientation that we have to capital that has really permeated our definition of what does success look like and what does success mean. And in Marjorie Kelly's book, Wealth Supremacy, she talks about our collective orientation and move towards capital or capital bias, and really how we apply the duties of care, loyalty, impartiality, and others around fiduciary duties towards maximizing returns and accumulating more capital to really, quote unquote, do more good work. But there's inherently a flaw here because the way that our current systems currently work is that they're extractive. And the way that we accumulate greater returns in the traditional markets is to extract labor, time, and money from those who have less power in our systems. So, in essence, all the work that we're doing to kind of grow our assets is actually negating so many of the benefits that we try to achieve by moving grants or other assets into community. So, what we have been doing in the past and kind of how we've been applying fiduciary duty to endowments or other kind of mission driven capital sources is just like not working to create the impact that we want. So, that's where I have started in the article. And that's kind of bringing everything forward to today. And really kind of where I sit, as you mentioned, Beth, like there's no real kind of legal requirement or obligation for fiduciaries and fiduciary duty to maximize returns or profits. As you said, kind of we have to balance kind of the different competing responsibilities and then think about purpose of capital. So I come to this today and I wrote this article because for a lot of mission driven institutions, I wasn't seeing that happen. I wasn't seeing that purpose part being kind of pulled into the conversation. And I think that there is an opportunity for us to reorient around some of these duties to think about how we might address the extraction and address ways to kind of rebalance or redistribute resources that have been accumulated, again, in this mission-driven context. So really quickly, kind of the three duties that I've talked about in the article. The first one is duty of care, and I've reframed it to duty of community care. And really here, what I'm trying to address is the way that we could balance our attention to not only matters of the individual and the institution, but also the communities that we seek to support with our work and also the ones that we're operating in. And I really feel like this reorientation could help us keep all impacted stakeholders at the same level and consideration when we're making decisions around capital allocation. It could even compel us to think about ways to reduce negative effects or externalities around our investments and think critically about what might it look like for us to actually increase tangible benefits for all stakeholders as a result of how we deploy our capital. The second is around the duty of impartiality. And really here, I've kind of reframed it to be a little bit tongue in cheek, but like duty of partiality to impacted communities. And, in this mission driven context, I really think about the need for us to continue to prioritize and remain partial to the fact that these resources are really supposed to be benefiting a mission or these impacted communities. And it gives us an opportunity to not only just reflect on how these resources were accumulated, but also what we might do differently to redistribute them in a way that continues to prioritize community benefits. And then the third is around the duty of loyalty, and I've reframed this to the duty of loyalty to community. With the context of how our systems are operating to extract resources from not only communities of color, low income communities, among others, I believe that a mandate to remain loyal to these communities over the self-preservation of the institution will really help us think differently about who holds power, who holds decision-making rights, especially as it relates to capital allocation. And I think it brings forward a question for me of how can we remain loyal to community, to our mission, to what we seek to do with these resources without the voices of those communities at the table. So these are just kind of a few of the ways that I think mission-driven sources of capital can start to think differently, and then hopefully start to create different outcomes or different futurities than the ones that we've built in the past.
And sort of what I'm hearing here, right, is this sort of the traditional approach, even if we have a mission-oriented goal, a mission-oriented organization or fund. First, we're sort of relying on or looking at a crutch of fiduciary duty to actually prioritize capital, to prioritize the amount of the financial return of that organization over its actual mission. And it's an interesting one, and one that really we should wrestle with, I think, and question. And I know, Kate, you've also sort of worked with organizations that are interested in actually investing for impact and exactly focusing on this, yet still sort of run into areas where maybe they hesitate. And maybe what do you find gets in the way, and how do they get past it? And how might this framework help others get past it?
Yeah, it's surprisingly common. I might even say disappointingly common for all of us that this happens for, in particular, these mission driven entities like a donor advised fund or a private foundation, where everyone is rallied around the mission. That's why they're there, right? So there's really good intent. But behind closed doors, when rubber meets the road, is where we really start to see this breakdown and this approach to fiduciary duty that privileges capital, even for a mission-driven entity, really shows itself. And I would say there are kind of four main reasons that if I really give it some thought and boil it down and peel back down the layers to the root of what might be going on, I think the first thing that gets in the way is sort of an unexamined notion of what is responsible, what is the responsible thing to do. And that deserves some interrogation, especially for these types of entities. Responsibility to whom? How are we defining responsibility? Like really unpacking that, because the unexamined answer to doing the responsible thing is to do the thing that prioritizes capital and increased growth at the expense, often in these choice points, of the mission. So there's the sense of responsibility that's disconnected from mission is a first obstacle. And the second thing, similarly, is where that leads to is an unexamined pursuit of more, right? More, because more is the more responsible thing to do, right? That it's the more prudent thing to do when you're faced with a choice. And, we're going to reference, I think, often Marjorie Kelly's book here, because I think she's a leading voice on this. But she refers to this notion of more in these boardrooms as like a sleeping gas, right? Like it just kind of drifts in and everyone is lulled into, of course, the right answer here is we need the higher return. So the second one, and underneath all of this at an individual level, at a organizational level, and at a collective societal level is the obstacle of scarcity, right? Scarcity thinking, scarcity feeling is very deeply rooted in our society. I mostly because we have not prioritized care of the collective, and so it is almost a rational response to move into scarcity feelings and make choices based on that. So that's a huge obstacle at the root of almost all of this. It's emotion and thoughts around scarcity, and last but not least of the four reasons that I could come up with is to Sadia's point here about impartiality and flipping that to be partiality to impacted communities. I think what we're seeing this another obstacle is partiality to the investor, right? So this and behind that partiality to the investment professionals, encouraging the conversation that leads to centering and being partial to the investor's result. Because there's this also, I think, unexamined belief, like, well, if we don't continue to grow our endowment and we don't have the money to continue to do this, then like it's not going to happen, right? Like this belief that it really centers the investor, and it centers that in, the investor or the board that's making decisions around an endowment, for example, what we're doing is superior than any other alternative, right? And if you are to interrogate that really, then that means you might have to consider doing something different, and that's challenging for some people to consider, right? Because maybe this is a lot. There's a lot of identity wrapped up in some of these roles for us, and to consider something different. So we have to grapple with that.
And one of the things we talked about when we were preparing for this was sort of about the origin story of some of these and sort of the financial return and financial benefit that has maybe already been realized by some of these organizations. So maybe Kate, if you could sort of speak to that, I think it was pretty eye-opening.
Yeah, this doesn't really get talked about, but it is just the truth, right? So we're talking here, I think most particularly about someone creating a donor advised fund, someone creating a private foundation, creating a pot of money who has a charitable mission attached to it. But it's always initiated by, a pursuit of a financial benefit, and that financial benefit being money from the taxpayers, right? You're getting money from the US taxpayers in the form of a tax deduction. That's the first trigger. It's usually initiated by a tax professional or an investment professional. Hey, you know what you could do? You could do this, right? The first justification is financial. The first benefit you're getting is financial. And then we're moving into being committed to a charitable cause, right? That's what you're pledging to do, and being accountable to do. But then why continue to pursue financial purpose beyond that original genesis moment, right? That origin story. You've gotten that benefit. So to continue to subordinate the mission to the financial returns, I think ignores this origin story for so many of these pots of money.
I mean, but we can't sort of ignore that there is a pot of money and you need the pot of money to achieve the purpose, right? So sort of thinking about that, and maybe there is an obligation, maybe even a legal obligation sort of in the documentation that founded this foundation in particular, or a trust, to exist in perpetuity, and how do organizations match these things, achieve the mission, and also achieve the legal purpose, the legal obligation, perhaps, or even a recognition that we've got to continue in perpetuity, to achieve both of these things.
Yeah.
How do we get past that?
Well, I mean, Sandhya was saying that it's not working, right? But in some respects, this is working perfectly to support the status quo, right? It's not working for a different thing, but it is working perfectly well for supporting kind of a late 20th century, early 21st century approach to how we do this. And the two main questions that we have to ask, right, is what is the mission that we're here for? What is the purpose? What is the purpose of this this money? And what is the timeline by which we want this money to accomplish that purpose? Those are the two basic questions, right? That any certainly kind of governance and an investment conversation has to be grounded in. But I think the ratio by which we've been answering this question skews perhaps not in the way that we would necessarily want it to if we looked at it from a different lens, right? Because if the mission is charitable and you're thinking about how long do you want to be doing this work, how long do you want to be doing this work? How long do you want to control this mission in this way? Then what is the appropriate ratio of mission to perpetuity, or mission to institutionalizing that work, right? And the way a traditional, let's call it like a private foundation that ratio really looks like 5% to mission, 95% to institutionalizing the entity, right? Because the institutionalizing is a stand-in for perpetuity. In other words, we need that 95% to grow so that we can continue to exist for this long timeline. And I'm not sure that that's what these entities really want to do most of the time, right? I think that that's actually, when you take a step back and look at what we're doing from that perspective, perhaps this is not what we want to do. Those are the questions to be asking, right? But I think it's the hardest question to come to terms with is, when is it appropriate to step aside? And, we can talk about different ways to do that bring community into that. I think that's exciting because you don't have to do all of this at once. The answer isn't necessarily everyone needs to go to a spend down. So I think that's important to hear, but I think it's important to grapple with the questions of, are we seeking actually to institutionalize what we're doing, or are we trying to do something different because of this mission we have?
Yeah. Yeah, Kate, I think there's so many pieces that I want to like pull from that, from what you just shared. A couple of thoughts, and then I'll return to what you had shared. But I think, for me, like there's a question around like, can we embrace perpetuity and also achieve all the things that we want to achieve? And, I just don't know. Like, I don't know the answer to that. I think I have a kind of inherently I'm seeing a tension between the notion of perpetuity and kind of what I see as a required outcome of moving towards an equitable economy, which would be the redistribution of resources that have been extracted from communities. Um, and so I think that those things are like in tension and not always in opposition, but can create kind of a lot of tension between this notion of perpetuity and or not. Um, I'm also, I think I'm also just like curious about this question of perpetuity, and I really like what you brought in, Kate, where it's like, what is the timeline that we're operating on? Like, we aren't operating on this timeline of forever because we haven't existed here in this planet forever, and we won't exist here in this planet forever. So like, how do we kind of grapple with like, this is the change we want to see, and actually having a conversation about like, and we're going to commit to like deploying resources over the next 15 years to be able to do that, or 50 years, like whatever that might look like, but really putting some more time definition so that there's also a sense of urgency. Because what I fear is that perpetuity really moves us to this conversation of kicking the can down the road instead of creatively thinking about how do we deploy assets now, um, or in the near future that help us kind of rebuild towards what we are looking for, which is an equitable economy, kind of more equality in general, a more kind of a more collective society that cares for one another, and all of those things, like they require us to take action now, not 100 years from now, or not through 5% grants, today and next year and next year and next year as our assets continue to grow. So yeah, I think there's this question, as a working at a nonprofit, and even when I started a nonprofit, there was a question around like, okay, so for me, like, I don't want this thing to exist for forever. So like, how do we grapple with like, what's the time scale we're operating on to create the change that we want to see? Um, and I think it's an uncomfortable question because creating that change upends the status quo, and we're no longer kind of maybe operating in the same positionality that we are right now. And that can be just an uncomfortable question to grapple with.
In a risk framework that people have to be sort of, well, doing something different is inherently risky. And so, questioning the assumptions raise some risk, and that got to work through that discomfort for sure. And I think sometimes one of the things that we had talked about is this idea that sort of traditional investing is somehow less risky than mission aligned or impact investing. The returns are certainly, any investment can have a different return, but there's this, I think, from those who sort of prioritize capital, or we sort of have this underlying assumption that pursuit of profit maximization is our number one goal. also sort of suggests that that is the only way to make money, right? There's um, the idea that investing with purpose doesn't, we forget that that has a return as well, that sometimes we just ignore in thinking through these questions. Have you, and I sort of see the question here and definitely some interest in it as we've been talking about perpetuity. Maybe this question about if you have dealt with it, and I don't know if you have, changing, like if it's sort of locked in, we must exist in perpetuity. Is that something you have worked through trying to change? Either of you?
Yeah, I defer to Kate. I haven't really, my work hasn't been explicitly on the kind of working with invest and like
Mhm.
wealth holders. But what I would say is I think it depends, right? I think it depends if there are living donors, if there aren't living
Right.
donors, and the board and the composition of the board to like motivate themselves to change some of those foundational documents. But Kate, I'm sure you have plenty of experience or kind of like familiarity with this, so I'll have you share from your perspective.
Yeah, and this is where it's good to have a Beth too, because it depends on what we're talking about. Are we talking about the operating agreements of a foundation, in which case,
Right.
how on board is everyone in the governance room to going about a process of changing that? What does your legal counsel say? I mean, where there's a will, there's a way, right? And if it comes down to like an investment policy statement, that can be rewritten so easily, right? But going back to Beth's point about the flexibility of fiduciary duty, for example, when you look at the legal, uh, I don't want to say it wrong, Beth, right? But what I took from what you said is there's room there, and it's really about documenting, and that's certainly the case when it comes to an approach to investing. It's just you're following an investment policy statement, and there's a lot that you can do with that. And really the power resides with the client. So if you're the wealth steward and the wealth holder and you've hired people to help you, their job is to help you figure it out. And if they are not willing to figure it out, then you should hire other people to help you figure it out.
It certainly starts with exploring the question, challenging the assumptions, and thinking through the issues. I'm not sure that it's always possible, but it's probably possible in more cases than we sort of assume at the first instance. Um, I'd be interested to think about, as people have explored more impact investing in these foundations and thinking about what their purpose is, what kind of processes or measures have you found that help them really lean into mission aligned, community focused investing and thrive in that process? What what does it take to convince the board? What does it take to actually to invest in a way that feels comfortable to people? Because that's part of this process.
Yeah. Um, the, I think, I guess where I would want to go back to is where Kate started us off in terms of like the four areas where people get tripped up and really thinking about, and also like it really does depend. Like if I'm talking to one high net worth individual, it's very different from talking to an institutional foundation where like I might be talking to, um, the person who runs their program related investment portfolio, but like also maybe just position in their position don't necessarily have that positional power to influence the way the entire foundation has been structured. So I think there's the answer is going to vary, but I think in terms of my experience of working, I'll kind of speak to my experience of working with high net worth individuals who may have kind of set aside donor advised um, funds in a donor advised fund, and kind of thinking about how they might deploy assets in that way. Um, I do try to reset when we kind of get to a point of like, oh, well, I need a financial return. I do really try to reset in terms of like, okay, as Kate said, let's return to the origin story. What is it that you're trying to achieve, like outside of the financial returns? 'Cause since you've already kind of received a financial benefit, what are you trying to achieve with with this pool of resources? So we don't like to have more.
Wasn't sure if it was me or the system. There we go. So I'm sure she'll come back. Kate, did you have a point you wanted to make on that same point? How do people actually thrive in seeking to move impact and investing with impact?
I think there's the who and the what and the how, right? So to break those down, um, who are you in community with to learn about this is important, so the work of impact PHL is a great place to be in community with others who may have more experience than you, who are doing this either at an individual level with a DAF or with a foundation, let's say. So who are you learning from? Who are you talking to? But also who's sitting in positions of decision-making authority? And again, are there ways to change up the who can help move forward? In terms of the what, sometimes I've seen it helpful to just take one step at a time and get the inertia moving in a different direction, right? So moving from not doing anything to doing something, right? It's very common to start with a carve out, but I wouldn't have the carve out be the end game. It's really a place thinking about it as a laboratory to begin to do something different while everyone gets acclimated and realizes that like this is working. This is, we're learning a lot from this. The world isn't going to end if we begin to do this differently. So sometimes it just takes cordoning off a little area to begin, right? And then you can continue to build out the journey of learning about it and reflecting and expanding as you go. And then the what is just the, what are you considering as expertise, and where are you getting that expertise from? Is your expertise coming from something more theoretical, or are you prioritizing an expertise, meaning an approach to solving the problem that the mission is seeking to solve? How you're defining expertise really can influence who you want around you, going back to the who component. So it's really thinking about the mission and what it would take to solve it, and who is around the table to help make that decision, and where it might be some gaps for that, like lived experience, for example, or really rootedness in it. Again, the who has to do with governance, and I think also the who has to do with your partners, the people that you're working with from a professional standpoint, and are they, I think looking more at the structure underneath that relationship, that business model, how you're paying them, what they're incentivized to do, what they're incentivized to not do, or not incentivized to do, and how much you can begin to change that with your own questions and your own encouraging of them to do something different. Because again, you are the client in that chair, and so people want to move where the market might be moving, and so you're signaling that as well. So you have that kind of power.
And as I've talked about sometimes that a fiduciary's kind of main obligation is to be informed, and being informed starts with questioning assumptions and asking a lot of questions, right? And so some of this is internal focused questions. What are we trying to accomplish here? What do we want to achieve with our money, with our grant making? with our organization, with our community. What sort of questions, if you were sort of guiding somebody through this process early on in this process, what kind of questions would you ask them to explore internally to get started on this, or to make forward progress where they are stalled?
Yeah, sorry. Can you all hear me?
Yes.
Great. Okay, wonderful. Sorry about that. The internet decided to cut out just in the perfect moment. But I think, I think to answer your question and kind of connect what I was talking about previously, um, I think it for me in conversations that I have, it really starts with what are these resources for? What's the desired impact, and what's the desired outcome of these resources? Um, as a impact first investor, my orientation is always going to be how do we utilize these resources to first achieve the impact? And then kind of there's a secondary, like if there is a financial return or whatever that needs to look like, we can kind of talk about that. But I do kind of want to start with what are the resources for? And then there's a question that I also try to examine around how much is enough? Like how much in terms of kind of wealth accumulation is enough in order to drive towards your mission or to exist if these are your own personal resources and you're kind of trying to align your own personal investment resources with more impact and community oriented investments. Like what does enough look like for you and for your financial um outlook, and how can we explore that in conversation together rather than it feeling like a kind of a black box that we're not really sure of each other's motivations. And so how can we kind of come together at the table and kind of understand where we're both coming from? So those are kind of the two avenues that I've taken previously.
Yeah.
And this
Go
is
ahead,
just kind
Kate.
of
You see
coming to
different.
me. Yeah, this is coming
Yeah,
to me
go ahead.
now. There can be a lot of power in walking someone out to an imaginary future, and saying, if we're standing here in 10, 12, 15 years time, and let's say we're talking to an entity that's responsible for stewarding a charitable pot of money. Let's say we're standing in this place 15 years from now, and your portfolio has grown well past inflation. You're still here as a steward of this money, but the issue you care about has gotten worse. Like, did we succeed, right? And really sit with that very potential reality. I think we could look back in time and see that could have been a correct prediction for where we are today, right? And not only does interest compound, but problems compound when we're talking about this poly crisis. So grappling with that question of like, oh, maybe we need to take a risk on doing something different, because actually if we got to that end result, maybe that is failure. And yeah, just plus one to a lot of what Sandhya said for some of the questions in terms of really rooting down in mission and reminding people when we're not talking about their personal money, that their concepts of enough and scarcity like really aren't applicable here, and so really that has to be disentangled as well.
Yeah. And one thing I'd sort of be interested to talk about, sometimes there's a lot of appetite for this, but then there's the cost, right? The cost, we've gotten really accustomed to free financial advice or very low cost financial advice, or, certain approaches to doing things. And there are potentially, changes that need to take place or we need to be willing to accept. to progress on this pathway. So how do you start exploring those questions or comfort level with taking on sort of more cost or taking on more risk, and sort of maybe exploring whether those are truly more costs or truly more risks?
In terms of cost, I think there's a lot of work to be done for people to understand what they're actually paying. There's a lot of uh, opacity. So I think the first step is really getting transparency about what are you paying, and then what are you willing to pay for is another question. And for entities that do things like RFPs or requests for proposals and go out and on the market and seek to hire investment advisors to help them with this work. I think if your main criteria is what you're going to pay, then you have to kind of loop back to question again your mission and if that really is what you should be prioritizing in that search. And if that's not what you're prioritizing, then encouraging transparency of what it would cost, to do something different, because it can otherwise be a bit of a race to the bottom in terms of fees. And the lower the fee, the less likely you're going to get people trying to do something that takes more manpower, more creativity, more ingenuity, and I'm speaking here solely from a little bit of a, what's happening inside the professional environment around this, but really just I think we could lift up more clearly here what it takes from what do the communities need, and the risks that are already being borne by communities. And so zooming out of this myopia, is that the word, of our portfolios to really understand the risk. There's risk happening everywhere all around us right now, and so it's an illusion to imagine that there isn't risk if that's what we're thinking.
Yeah, I think to add on to what Kate shared, and I think what everything that you brought up, Kate, is like spot on. Um, I think there was a recent report that came out, kind of the true cost of impact first investing, by the Miller Center. And yeah, it is more expensive. It's more expensive to do things that are more mission aligned, that truly reach the communities that we seek to support. Um, but that doesn't mean we shouldn't do it. And there is a reason why it costs more, because to do so requires more support, more kind of technical assistance, more infrastructure, like more connectivity, more hands-on support. Um, I think kind of coming to terms with the fact that our current traditional markets were actually, they're efficient now because of the vast amount of resources that were put in as subsidies to make them efficient. And so we're not thinking about that when we're kind of building the market essentially for community-led investment right now. And that is a role that philanthropy can actually take, is to help build the infrastructure for this work. And that requires a lot of subsidy, to reach scale, or whatever we want to define as scale, as communities define that. I think the second thing around the question of risk, Beth, is um, I think I have a visceral reaction always to this like question of like, what is the risk, or like, this is risky. And it's like the visceral reaction here is like, what is the risk of not doing this? Like, to Kate's point earlier, what if we reach 15 years from now and everything is worse? Isn't that the bigger risk? And so, what is the kind of creating that a little bit more sense of urgency around like, what is the risk if we don't make this investment in community now? What is the risk, um, to achieving our mission in the future? And I really kind of that, flipping that question away from like, what is the risk of doing X, Y, and Z, to what is the risk of not doing X, Y, and Z, I think is the way that I try to approach this, this work and kind of the urgency of this work.
I think about the question of what is the impact we seek to have, what is the impact we currently are having, because of course we are having an impact, and perhaps we should be thinking about trying to design that impact rather than just let it happen. One of the things also sort of thinking about the cost is maybe this is the cost of building the system that gets us to the better impact, right? The cost of the financial advisory services, et cetera. But it's just so much of this, like I love the way you sort of framed your article, Sandhya, is that it's reframing, it's really reimagining something, is that we have a system, you can think about working within it. We've got to do that because we have it. But also what could it be? And sort of in both instances, working within the system we have while trying to design a system that we think is better. And that is, it's maybe not a very comfortable place, but it's certainly sort of perhaps for some better than resting in the one that we have currently. So easy first steps, where to sort of start with this. And certainly I'm sure Sandhya or Kate has answers. I think one of the things that I have seen is one, getting somebody in to talk to your board about these types of issues and sort of start to raise these questions. And two, look at your actual portfolio for some of the things, for some of those investments that are clearly in contradiction with the mission. If you sort of invest in prisons and you're most nonprofits would not be interested in that. So those are some of the areas that I would start with. I also see another question here that I just wanted to sort of uplift. I don't know, Kate or Sandhya, if you saw this question, but sort of a question of, is one of the things that we're worried about in approaching this is sort of looking foolish in not getting a return, in not optimizing for financial return. Is that a question worth exploring with the board?
Well, it's always hard to generalize. So people, right? Like yes and no and maybe, I think is the true answer to Margaret's question there. I think it's actually quite common. It's nobody wants to be a sucker, but what does it mean to be a sucker? And going back to the question of what if we're here in 10, 15 years and we have all this money and yet we haven't, our problem is worse, or the thing we're organized around solving with this money, then what's foolish then, right? So I think it takes courage, right? I think the very first step is courage to ask the question, courage to share this recording with someone else, like courage to just begin to think about what happens if you do it differently. I think if we're talking about something that is any sort of invested pot of money has to have an investment policy statement. So look at the investment policy statement with detail and say, where could this use a little sprucing up to more explicitly align to what I'm trying to do, and write it in so then it has to be adhered to, right? That's another concrete step to take.
Yeah, I think in addition to the fact that it takes courage, I mean, I feel like it's like just actually harder to operate in this way. Like logistically, it's harder um, to shift and kind of orient your money to your values. It's not if there's no easy button that requires you to talk to a bunch of different advisors. It requires you to kind of push your advisors in a different way. It requires you to really take an active stance every step of the way around kind of what does it mean for you to actually align your values to what you're doing on a day-to-day basis. And so I think, I agree. It takes courage, but it's like it's hard. It's not easy to do these things. Like our systems are not set up for us to do these things in this way. And so, in addition to courage, like stamina to keep asking the questions, keep digging, keep pushing. Um, I do believe that, like, yeah, it's hard to do the harder thing right now. But you are also a part of making it easier further on.
like I tell my kids, we can do hard things. I think the word there is
Yes.
commitment, right? It takes courage and
Yes.
commitment to just weather through the hard things. There are people going through much harder things that we're trying to organize around with this money to solve, right? So it's a little bit of that humility of where we're standing when we're having these conversations. Of it's just it's okay. And yeah, I think just to underscore something that we talked about earlier, I think that there's a real need to fund with philanthropic dollars as well, the ecosystem to do this work, right? So in order to make this bridge, if you think about like the two loops theory, for example, like we have to go from a system that is entrenched and maybe not going to work well in the future to something new. And so if we expect this to be already built out, we're going to be severely disappointed. So what are ways that some of this philanthropic capital in particular, from a more catalytic standpoint, can be used to support these ecosystem structures to be built, while at the same time then looking at other uses of capital to make other changes.
Thank you. And I think we're just about at time, so I kind of like the idea of stopping with, we can do hard things, we should fund the ecosystem, and we should really question assumptions when somebody tells us, no, we can't do this. And with that, I think, turn it back over to Corey to remind us what else Impact PHL has coming up in the near term.
Yeah, I like the idea of ending on time, so I'm just going to say we have upcoming events, another webinar in February. We have Total Impact Summit in May. I want to thank you all for taking time out of your afternoon to join us here, and thank our speakers and Beth for moderating and organizing the conversation. Thank you.